So this is a journal entry question that gets to equipment purchases and corresponding depreciation expense. We don't get into the calculation of depreciation expense on here. We just give you the amount. So on January 1st, a firm purchases $4,800 of equipment using cash. Depreciation expenses of $200, all right? So we're going to do both entries. They want an entry for both. Let's do both, all right? So first, we're going to have our debit and our credit here, right? And our debit, we're getting an asset, right? We get equipment. All right, we're getting equipment. So we have a debit of equipment for $4,800. All right, that's the debit to equipment of $4,800. All right, and how did we get that equipment? Well, it says we paid cash. Well, cash is what we're going to credit. Cash, we know it's going out, it's going down, and that meaning we're not having this asset anymore. Debits increase our assets, credits decrease it, and if cash is going out, that's a decrease. So we credit cash of $4,800. All right. And then we go to the debit and credit associated with the depreciation expense. So this is for the purchase right here. All right. So then we have the depreciation expense. All right. So the depreciation expense is a little bit unique. All right. So our depreciation expenses are going to be debits. All right. Our expenses are debits. And the depreciation expense represents the economic cost of just owning assets that lose value. For example, I have a minivan that I'm pretty sure lost all its value in the first 3 weeks of ownership because I've got 5 kids. All right, so the depreciation expense associated with this is well, at least with my van, is significant. This depreciation expense right here is $200. It's associated with the equipment you purchased, and so we're going to write that down. So depreciation expense, expense, all right, of $200, all right, the depreciation expense of $200 is a debit. So here's our equipment and cash journal entry. Our depreciation expense, I'm going to just abbreviate everything here. Depreciation expense is for $200, all right, but what's our credit? What is the credit? Some of you might think, oh, maybe it's a liability of some sort, or we've already reduced our depreciation expense over here, so maybe it's a liability. No, it's not a liability. It is what's called a contra asset. It's one of just a few accounts that are asset accounts that maintain a contra asset balance, meaning they maintains a credit balance. And this is called accumulated depreciation. Accumulated depreciation. And so the accumulated depreciation is $200 here, and it gets reported here. All right. And this accumulated depreciation right here is a way to write down this equipment value without it actually leaving the business. It enables us to keep a historical cost here and show the economics of what's going on with the equipment losing value over time. So the way you do these journal entries is, the straightforward cash for equipment trade that we often see with assets on some journal entries. And then depreciation expense is a journal entry hitting your income statement, depreciation expense. Every year we do this. And then accumulated depreciation is a maintained balance that we have in our accounts for all the depreciation that's accumulated. And as it's accumulated, it gets netted with these assets on our balance sheet so that when we're showing equipment of $4,800 on our T account down here, and we have depreciation of $200, the net after all this is done is $4,600. That's the value that we'll have on the books after this depreciation expense. The net, the delta, the difference between these two, the asset and the asset right here, and then the depreciation amount.